Hi everybody. Today we're talking about time value of money and the related concept of present value. As you know, a dollar today is better than a dollar tomorrow or a year from now or several years from now. Why? Because if you have money today, you can invest that money and you can earn interest on it, whether that's in a bank or or whether you lend that money to someone and they pay you interest. There's a separate video on that in Notes Payable. Make sure to check that out. So with accounting, this concept is very important as well because, for example, you run into things like if there's, say, a $10,000 liability at issue, right? If I agree to pay you $10,000 5 years from now, should I report a liability of $10,000 on my personal balance sheet, or should I record a different amount? I mean, there's tons of questions in accounting that are touched by these concepts. So it's really important that we go through it. Really important to understand the present value formula. So here it is. Present value is calculated by finding 1 divided by 1 plus I being the interest rate, to the power of n times amount. Interest rate, n is the periods, typically years. We're going to use years in our example coming up. The amount is just the amount at issue. So, typically it's going to be money that is going to be borrowed or lent, right? Conversely. So if we're saying a simple scenario here, I have the opportunity to receive $1,000 cash. Okay. Let's say today is January 1st, 2019. Okay. And I have the opportunity to receive this $1,000 cash December 31st, 2021. So that's 3 years, right? All of 2019, all of 2020, and all of 2021. Okay. Interest rate, if you're watching this video because you're in an accounting class in college, or you're just studying accounting, interest rate is often given to you in your courses. But let's say in our hypothetical here that the interest rate is 10%. We're just going to keep it simple. So this is saying that if you invest the money 10% annually, right, you're going to get 10% return. So our question is, if we know that I'm going to receive $1,000 at the end of 2021, what's the equivalent of that if I want to represent that on January 1st, 2019? Right? In other words, what's the present value of $1,000 in 2021? What's the present value of that today on January 1st, 2019? And that's where this formula becomes really important. So 1 divided by 1 plus, the interest rate is 10%. We're going to represent that as a decimal, 0.1, right? Because if you put 10, then it's going to mess it up completely, because now what you're saying is instead of 1.1, you have 11. So careful not to do that. Always convert it to a decimal. And you'll see in a sec why this is important. So periods, here it's 3 years. So to the power of 3. And the amount is, we said 1,000, right? If you plug this in to your calculator, what you're going to get is a present value, PV, of $751.30. Remember what this means. It means that getting $751.30 on January 1st, 2019 is as good as getting $1,000 at the end of 2021, right? Assuming a 10% interest rate. So the interest rate could vary. For our purposes, we're saying it's 10%. Now, how do you check this, right? How do you know? Well, here's how you know, and here's why it's so important to convert the percentage to a decimal. Let's go the other way now to check our work. So 751.3, we're saying it's worth less because we're going to invest that money, right? So money in the future is worth less today, right? The $1,000 that's going to be 3 years from now is only worth 751.3, right? So if we invested at 10%, it should get us to $1,000, right? Because all we're doing with this formula is just working our way back. So if you do 751.3 times 1.1, which is just saying that you're increasing it by 10%, right? You will get 826.43. So that's 1 year that's gone by, right? If you put that $751 either in a bank or you lent it to someone and you're receiving 10% interest. So 1 year has gone by. You do the same thing. Times 1.1, 909.073. 2 years have gone by. And now it's the end of 2021. 3 years have gone by. And you have $999.98. So some rounding error there. But now you can see hopefully how this works. So the present value of 1,000 under these circumstances, right? 3 years, 10% interest rate is going to be $751.30. Well, then it only makes sense that going the other way, the future value of this $751.30 is going to be 1,000. Okay, so I hope this was helpful. Time value money and present value come up all throughout accounting. I'll be sure to flag that when it comes up in other videos. I hope this was helpful. If it was, please give me a like and subscribe, and I'll talk to you soon.